Alright guys, let's get this presentation started. This is a video recording of the Lunch and Learn education series that we presented this last week on January 16th, 2019. And we are going to navigate, is your portfolio ready for a bear market? If you're not familiar with who I am, my name is David Zarling. I'm partner and head of investment strategy and research at Client First Tax and Wealth Advisors. And I give presentations at our Lunch and Learn every quarter, and we look at market insights both from the past and getting a grasp on that evidence and looking forward with it as we look at probabilities and as we use our Adaptiv System. So this is part of our Lunch and Learn education series. If you're watching this video, maybe you couldn't attend in person, or maybe you did and you wanted a refresher on what we went over. I got a lot of positive feedback in emails about this presentation, so I really appreciate that if you were one of those to send that to me. If you're ever interested in coming to one of these, you can find our schedule here at clientfirsttaxandwealth.com /2019 financial education schedule topics. And you can always call us to reserve your spot. It is free. It's really good food. We have it out at the Columbian, and they have some really good food. We learn some new things, and it's typically the third Wednesday of every month, and you can look at that schedule here again. We have a good time. It was a packed house, and we go over a lot of great things, and we're going to do that today for you guys. As always, I've got to cover the legalese that this information is really for educational purposes. There's going to be a lot of illustrations in here, and it's not going to be, this presentation isn't tailored specifically for one individual, and every individual is unique, and that's why we do true holistic planning here at Client First, because everyone is unique and everything ties together for their own personal best interest. And so really don't use this presentation for your individual basis for investment decisions. And if you're looking for any additional legal restrictions in terms of use, you can go to this website here, video content terms of use. So if you attended last month, or last quarter I should say, in October, or watched the video from that presentation, and we do have it all on YouTube and you can check it out, you might be familiar with my oldest son, having gone through hunter education, and we talked about this acronym TAB-K, where it was implemented in the early 90s, and we can see that since this hunter education, which started way back here, and TAB-K were introduced, there's been a dramatic reduction in hunting accidents using a gun. And part of that is just learning how to manage risk, right? We're going to talk about risk management today, and it may not just be regarding hunting, but it's also involved when we manage money or when we are in markets. But in this case, for hunter safety, Eli had to learn to treat every firearm as if it were loaded. He always had to point the muzzle in a safe direction. You had to be certain of your target and what's beyond, and keep your finger out of the trigger until ready to shoot. So this last year was his first year to go gun deer hunting, and we're pretty spoiled where we get to go. We do get to hunt on some private land, and it was a good time. And so I'm about to spoil things for you to let you know how it went. Obviously this picture gives you a little idea, and if I can, I like to tell my hunting story, because that's part of the fun, is being able to tell people the successes and failures in that process, because all of it is fun, because we're outdoors and we're enjoying God's creation, and it's a great thing. And we hunt over by the Mississippi on the bluffs, and it's my father-in-law who's so kind to have us out there, and a friend of his by the name of Roger who lets us on his land, and it's a really great experience. The way we hunt mornings. We still we sit in a stand, or we're sitting in the mornings. In the afternoons, we cover a lot of ground. We drive, and so we're pushing deer through the woods and through fields. And Saturday morning was our first morning. We didn't see anything. We were sitting in a stand on the edge of a field. Eli didn't really care much for the stand itself, not because of the height, but the bench wasn't all that great. But that afternoon, we covered a lot of ground. Each of the days that we drove, we covered between 10 and 13 miles, and so it's hard work. We're up and down hills, but we saw a lot of deer. That Saturday we saw more than 20 deer. Sunday we saw almost 30 deer, and even Sunday morning we didn't see much. We went back to the field and sat up. It's actually right here along this field edge here, And we sat there. We took some chairs. We grabbed some chairs off the patio since it wasn't comfortable in the stand, and didn't see anything, and this spot's a honey hole. It's not a matter of if, it's a matter of when. And we're sitting there, and we didn't see anything. And of course, that afternoon, Sunday afternoon, we saw plenty of deer while we were doing drives. And so we were pretty worn out. And Monday morning, Eli was pretty tired, and it was like Velcro trying to get him out of bed, because in his mind, right, recency bias, which we all are exposed to and have a condition towards, in his mind, why would we get up early in the morning and sit somewhere not to see anything when we can just do drives and see all the deer? So in his mind, recency bias, that information was the deer come out during the drives, we're not going to see anything in the morning, so why would I do this? But I told him, you can't shoot a deer from your bed, so you got to get out. You got to get out there. So we go out there, and our game plan was that I'm going to face the woods with my chair, he's going to face the field with his chair. We'll sit next to each other. If I see something, I'll whisper to him. If he sees something, I'll hear it, because he'll unclick his safety. So sure enough, a little bit of time goes by, and all of a sudden I look over, at him, because I was like, man, he's doing a really good job sitting still. And I hear him say, oh, crap. And he slowly pulls up his gun, and I only allowed him to put one bullet in the chamber. And so I'm excited, because he's obviously on a deer. Boom, he pulls the trigger. I jump out of my seat, and I turn around, and I'm looking, and there's a really healthy doe running into the woods, and so it's like bittersweet. I'm kind of bummed, because boy, that deer looked like it's doing pretty good, but I'm excited because my son got an opportunity to hunt and try to shoot, and he actually pulled the trigger, and so I had mixed emotions. And all of a sudden I turned to him, and if you can picture this, right, he's almost down on one knee, and he's fist pumping, and his hands going up and down in the air, and I'm confused. I'm like, what's going on? What's happened? And he points to the field, and sure enough, there's a doe laying right on the ground. A very nice shot, a very clean kill for this animal. And so you can tell by his smile how he felt about it. And so it was a good weekend. Eli still got his sleep in on the way home. And you'll notice something about this, the fact that I'm presenting this and that you can see Eli smiling, is that we were safe too. Not only were we able to have a harvested deer, but we were also able to be alive, and that's part of that tab K in risk management. So thank you for letting me tell you that story. We're going to actually jump into this thing now, and you can expect this to be about 45 minutes, okay, as we go through this. So if you want to sit down with a cup of coffee, or you want to digest it at 15-minute increments, that's your choice. That's the beauty of YouTube, is you can pause it and come back, whatever you want to do, or you could sit for the whole thing. And so what we're going to cover here were 2018 market environment where there was nowhere to hide. It was a bloodbath out there. We're going to review the math problem with buy and hold investing, which is what the majority of the world says to do. If you meet with a lot of financial firms, advisors, they're going to tell you to diversify, so own everything and hold it forever and ride out all the bad markets. We couldn't disagree more with that, and we're going to go through how the Adaptiv System identifies and navigates bear markets. And then we're going to kind of do a case study, review how we help new clients mitigate problems in their portfolio. And then we're going to dig in and find out, is there a bear market upon us? What does that look like, and what's the game plan for it? Then normally we'd have question and answer, and what I'll encourage you to do when we get to that section is just go ahead and email us with any questions you have, and we'd be more than happy to answer them. We're here to help. And then we'll wrap up with some final housekeeping and final thoughts. But 2018 was really an interesting market year. There was really nowhere to hide. And maybe you've seen things on Pinterest like this, where someone posts what the perfect cake looks like, and that's our expectations, and then we go ahead and try it, and I know this is what my cake would look like if I tried to make something like this. And so we have expectations versus reality. And how does that happen? How do we get so misconstrued in reality based on expectations? And some of that has to do with our prior experiences, right? We talked about Eli not seeing deer in the mornings, but only on his drives. Well, that's a result of the most recent information in his life was that's when you see deer, even though that may not actually be accurate. And so 2018, when we look at that year, and I don't want to pick on these people because they have a job to do and they're asked for their projections, You'll never get a projection from me, but every single major economist from these research firms, whether it's Morgan Stanley or T. Rowe Price or Merrill Lynch, or all these individuals predicted that 2018 would be higher in the stock market. And they rightly so, they might have been influenced by 2017, and we'll get into that in a moment. And the news cycle was the same too. We saw places saying, hey, 2018 is going to be really, really great. We had famous hedge fund managers, Ray Dalio, if you're not familiar with him, saying, if you're holding cash, you're going to feel pretty stupid. We had all these major financial firms, every single one. There wasn't one that picked the market to be lower. And we got to compare, what was that expectation versus reality? Well, the most recent information was 2017, which was a really nice bull market. This is the S&P 500 here, only 1 month down in 2017. Volatility was, this is daily percentage moves, and so plus 1%, minus 1%, super low volatility throughout the year, and everybody thought that was going to continue. The expectation was that 2018 was going to be a great year. Well, we saw dramatic volatility in February and March, October and December. So you had, 4 months there with negative outcomes and dramatically increased volatility to the point of, almost minus 4% on some days, just really increased, volatility. And so we had the expectations of 2017 coming in to 2018, but reality is reality. That's the final verdict. Another way to view it, here's another look at the S&P 500. Here's 2017, really nice rise in the market, very low volatility. January is one of the best Januaries we ever had, and then things change, right? Great year in 2017, and then all of a sudden volatility and selling in 2018. And so we have expectations versus reality. In fact, it was so dramatic in 2018. What I'm going to show you here is that if we look at 2017, right, and we say, okay, how many assets across the planet, right, that are available to U.S. investors, how many of them had a positive return, right, so that they made some money? Well, 99% of assets were up, whether it was bonds, commodities, stocks, you name it. 99% of them were up in 2017. So you literally, and I know this is a famous saying, you could throw a dart at a dartboard and pick an investment. In 2017, you could have, that in a way, you could have picked something because only 1% of assets had a negative return. Now, 2018, very different story. Only 7% of assets had a positive return. That means 93% of assets had a negative return. So if you're buy and hold and diversifying and you're owning this whole pie, well, because you're diversified, you're owning 93% of what's in that portfolio then is negative on the year. And you definitely could have thrown a dart and got a positive return during that period of time. So 2017 lulled people into thinking anything they owned was safe. 2018, definitely a different story. Only 7% of items had a positive return. In fact, we went from, like we said, only 1% of things having a negative return in 2017 to 93% of assets. This is the most on record going back to 1901, 93% of assets having a negative return, and that was the reality of 2018. This chart's a little busy, and I'm going to walk you through this real quick. So if you think back to our chart here, this one, where we talked about 2018, when we talk about the green slice here, this 7% that did have positive return, so what we're about to talk about is this green slice here on this chart. This shows how many assets that were positive had a greater or equal to 5% gain during the year. None did. So not only were there only 7% of assets that were positive on the year, in that slice, none of them had greater than 5% return. That's pretty dramatic. And this down here shows you the median and average return for all asset classes, so the highest and the lowest in the mid-range. And this is quite different if you look at the past where it has been before. You might have a year like this back in the 60s or early 70s, and you at least had some max return that was pretty decent. We didn't even have a max return that was positive. And so this gives you, these two data points just tell you how thin it was out there in order to find return. In fact, if we look at asset class returns, right, and what I'm about to show you includes all dividends, all incomes, fees are included, so we get an apples to apples comparison. And we can see large caps, small caps, emerging market stocks, Europe, Asia, Far East stocks, preferred stocks, high yield bonds, investment grade bonds, long duration treasuries, inflation protected securities, US total bond, emerging market bonds, REITs, gold, commodities, all negative. Only thing that was positive was cash. When we look at global returns, what was going on in stocks across the country, all of them negative. I know they talk about, don't cry for me, Argentina, but we should probably cry for Argentina, minus 50% back in 2018. Not great. When we look at the 25 largest equity ETFs, right, these are the ETFs that have the most money in them, all of them negative, whether it's the S&P small caps, whether it's Europe, Asia, Far East, whether it's value, whether it's growth, all of them negative on the year. When we look at very important sectors like banks, okay, in 2018, U.S. banks, right, whether it's J.P. Morgan, Goldman Sachs, Bank of America, Wells Fargo, all of them negative, either minus 6 to minus 33% on the year, and that's including dividends, right? In Europe, right, HSBC minus 16%. Very important banking institutions. One of the most important banking institutions in Europe, Deutsche Bank, down minus 56%. That's a big deal. And so it's not a great market environment when we see banks selling off or financial institutions selling off. When you have healthy financial institutions, typically that means the economy is doing well, the market's doing well. Not in 2018. That was not the case. Banks were selling off both in the United States and over in Europe. Now, when we look at common asset allocations, right? When we look at, okay, if I go to a financial firm, typically they're going to put you in what's called an asset allocation, and it's going to be a breakdown between stocks and bonds, all right? With the most famous allocation being a 60-40 portfolio, so 60% stocks and 40% bonds. Okay, and it can be anywhere on that spectrum. For example, this line here, aggressive, here this is 80% stocks, 20% bonds. Or you could just own the S&P 500 by itself, or you could just own bonds by yourself. But all of these asset allocations were negative on the year. And again, this is after dividends and income are included and fees are included. What I'm trying to do is give you a realistic view of what happened for most people based on the allocations that they're given. We're humbled by the fact that the Adaptiv System was able to provide positive returns for our clients in 2018. Okay, adaptive growth was plus 5.1%, adaptive moderate 3.9, balanced 2.8, conservative 2.3, ultra conservative 1.4. And again, these returns are after dividends are included, income and fees. So these are real world comparisons, right? And it's from 1/1 to 12/31. And again, it was a humbling experience because if you think about it, 7% of assets period had a positive return, and we had whole accounts that had a positive return. So there was dramatic outperformance in the market. And to drive that point home, if we were to look at what would it have been like to own a 60-40 portfolio based on the previous screen in 2018 versus being in adaptive growth or adaptive moderate, right? So a 60-40 allocation in 2018 had a negative 5.8% return. What I did is I put some hypothetical balances that a person might have invested in the market or in this allocation. A $1 million account with this type of performance would have lost about $58,000, right? If we compare that, and we won't even use adaptive growth, which had a very nice 5.1% return. Let's just use adaptive moderate. And the reason why I included these both is about 95% of our clients fall into both of these models. And here's adaptive moderate up 3.9% after fees. It has about, a $39,000 gain. Well, that's a pretty dramatic difference. Not only are you avoiding minus 58,000, but you're enjoying almost 40,000. And so the net benefit is almost $100,000. That's real money. That's the difference between being in a buy and hold diversified 60-40 portfolio versus being in adaptive growth or adaptive moderate. It does add up over time to be real returns and real money over time. And so I wanted to show you that because there is a difference between buying and holding and being adaptive. So what is the math problem with buy and hold investing? Because there is one that many people don't talk about. Because many places say, we're going to be passive, buy and hold, we're not going to try to time the market, etc. And what we see as being a part of the problem is if I can use the S&P 500 as an example, and again, a couple things here. The S&P 500 isn't the be-all, end-all. It just it does a good job representing the large U.S. stocks in the United States. It's 500 of the largest U.S. stocks, and when we look back, this chart goes back to late 90s. We can see the value of this basket of stocks change over time. More selling than buying, pushing prices down, more buying than selling, pushing prices up. And what I want to highlight here is let's just use the example of being exposed to the market as a whole during this time period. Here's 2000, right? The dot-com bust. Here's 2007, 2008, the great financial crisis, and here's 2013. So a $500,000 account exposed to S&P 500 for 13 years went nowhere but heartburn, right? So that's a 13-year period. And for context, these moves down. This one's about 50% down. This move down here is almost 60%. And so if you think about that, if you are in retirement and your account drops by half, okay, let's just use the simple example of that you need to take a $20,000 distribution to fund your retirement because you're in retirement, and that $20,000 distribution in 2002 comes in this period here. That $20,000 that you were planning on here is now $10,000. And to make matters worse, you have to take $20,000 here. That $20,000 would be $40,000 by here. So it is a double-edged sword when we have to start taking distributions in retirement. And to drive that point home, as we go down in drawdowns in the market, as we go down in value, it takes more and more to get back, right? So if I have $100 and it drops to 50, that's a minus 50% loss. But then to get back to 100, right? 50 on 50 is 100% return. So we see that as we start going down this spectrum, a 10% loss takes 11.1 to get back to even. A 50% loss takes 100% to get back even. A 70% loss takes 233% to get back to even. And so my point is, we don't wear a parachute to go skydiving. We wear a parachute so that we can go skydiving again. Or for that matter, anything that we want to do in life after going skydiving, we wear a parachute. Okay, and so you have to keep that in mind. Same thing with sequence of returns. Okay, there's something going on here that I need to highlight that really impacts. I like to point out to people if we're lucky or blessed, we get to possibly pick where we live when we retire, but we don't get to pick the market we get when we retire. And what this chart shows is it's basically saying having people with $1 million balance retire in two different time periods. This person is retiring and is experiencing the returns in the market from 1989 through 2008. This person, we're just flipping it in return, or flipping it in chronological order. So now they're getting the 2008 return and then going backwards. So the point being that both examples have the exact same, 10.4% average return. They have the exact same different returns on a year basis, but it's the sequence those returns take place that really impact things. Okay, so this individual during this period of time, right, almost a 20-year period of time, has $1 million balance turned into 3.4 million. But just because of the sequence of returns, the difference in returns during this period of time, this same $1 million with a 5% withdrawal rate, which is the same as this one, has only 800,000 left at the end of that 20-year period. So it adds up over time. So sequence of returns is a big deal. Market drawdowns are a big deal. Now, you may have heard from other, and I've been hearing it on the radio lately and TV, that what if we miss the best days in the market, right? What if we the best days being like, hey, oh, the Dow's up, they'll use a point, rather than using a percentage, they'll be more dramatic and say, oh, it's up 1,000 points. Really, we need to be looking at percentages, but what if we miss that 3% day in the market? The media likes to point out, and even academia, hey, you got to stay invested because you don't want to miss those best days. So let's investigate that and do a little bit of research, because we don't want to just take them at their word, because the media might not necessarily be the most or the best information that we can come across. And so what we want to look at is, what if we miss the best days in the market? So we did a little research, and we looked at data from 12/31/1984 through 10/18/2017, and this research was actually done back then because 10/18/2017 was the 30-year anniversary of Black Monday, which was the 1987 crash. And so we wanted to include all those different periods in here to see, what if we looked at the Dow Jones 20 best and 20 worst days since 1984. And what you'll notice is, like this day right here, 10/21/1987, that's an amazing day, 10% higher, okay? But also notice how close that is in proximity, temporal proximity to 10/19, minus 22%. Okay, so when we look at best days like this, 10/28 plus 4% in the market, it's typically surrounded or clustered nearby with negative periods. For example, we all are familiar with 08 and 09, the great financial crisis. When we look at this, we can see, look at all these best days, the ones in green, that's a lot of best days. But what we don't talk about is how close in proximity the worst days are to the best days. And so we can't just take best days in a vacuum. And so what I want to point out here is, if we buy and hold the Dow Jones from 12/31/1984 through 10/18/2017, your total return would have been 1,800%, a little above that. That's pretty good, not too shabby. Now, if we miss the 20 best days, which is what the media is talking to us about, our return would only be 484%. So absolutely, it is true that if we miss the best days in the market, we would have a lesser return. But what about if we missed the worst 20 days? Well, okay, obviously, if we were able to time the market perfectly and we missed the 20 best days, our return would be dramatic. It would be 8,500% rather than 1,800%. But what we need to remember is, when we talk about just missing the 20 best days, we should probably also consider what it would be like if we missed the 20 worst days. So why don't we just look at, if we missed both the best and worst 20% days, what would that look like? So buy and hold, as a reminder, from this time, in this time period, 12/31/1984 to 10/18/2017, your return would have been 1,800%. Pretty good. If you had avoided the best 20 and the worst 20 days in the market, you actually get a better return. It's 2,600%. So almost an 800% outperformance. That is an $800,000 difference on a $100,000 initial investment. So this study proves that if we miss the best and worst days, because they tend to cluster together, we're actually in a better scenario than if we would have been if we have buy and hold. So this whole missed best days, it's a half-truth, and I hate half-truths, okay? So we need to make sure that we're not just looking at the missed days in a vacuum. You got to take it together, and what does that look like? And we know that if we miss both the best and worst days, our return is actually higher than buy and hold 1,800. So how do we do this? How do we possibly identify when we could be in an environment when those best and worst days are happening? Well, what we use is our Adaptiv System. This is very unique to us. We're not aware of anybody else using this, and that's why we've given its name, because it is adapting to different market environments. And so I kind of want to run through for you what the Adaptiv System is. For some of you, this is a refresher. For some of this will be new. But it's really identifying three things. Price, so economic law, supply and demand. More supply than demand, price drops. More demand than supply, price rises. And then we use that information to identify trends, which sounds very cliche, but we'll cover that here in a moment. And then same thing, we use that information to identify relative strength, which we're also going to cover in this presentation today. But quite simply, let's use the S&P 500 again. All right, price is fact. We don't get to argue with it. We don't get to, if the price of Apple is X dollars, when we go into the market, we don't get to say, oh no, it's not worth that. No, we buy and sell based on what the price is that day. And it's based on buying urgency and selling urgency. And so for the S&P 500, we see buying and selling taking place over time. More selling than urgency than buying urgency driving prices down. More buying than selling pushing prices up. And this happens over and over and over. And what we do to identify trend is we take the prior 40 weeks of information. So that's what this blue line is that's running through here, is the prior 40 weeks of information averaged. And what it helps us do is identify, are we in an uptrend or are we in a downtrend? Because we want to always invest with the trend. If we're in a downtrend, we don't want to be involved with that. And the other thing it helps us do is it helps us avoid daily and weekly noise. What do I mean by that? If you envision watching a movie with your nose on the screen, you're not going to see very much because you're only focusing on a very narrow area. Same thing, if we're only focusing on daily and weekly price movements, we are missing the big trend. Okay, so the blue line helps us step back and see the big picture. Then what we do is we combine that with this orange line here, which is 10 weeks of information. Okay, and what we know, so blue line, 40 weeks of information, orange line, 10 weeks of information. What we know is that when orange is below blue, that's when bad things tend to happen. It's not a guarantee that bad things are going to happen, but it's very similar to if there's a snowstorm. We could absolutely go drive in it. It doesn't guarantee we're going to get in an accident, but it's when accidents tend to happen is when we're in a snowstorm. So we just simply make a rule that when orange is below blue, and we can use these orange and blue lines on anything, bonds, commodities, you name it. On this example, we're just using the S&P 500. When orange is below blue, we're going to protect accounts from that thing. Same thing. When orange is above blue, we're going to be involved with that thing. And so it's like I said, it's very similar to saying we don't need to drive in a snowstorm, because what we know in markets is when orange crosses below blue, it's in that environment that volatility picks up, selling picks up, and it's time to park the portfolio and be safe. And when I say protect the portfolio, it's a couple different things. We can move the account to cash. All right, that's very unique to us. Not many other places move accounts to cash, and it's at FDIC insured at TD Ameritrade. The other thing is we can look at other things that are orange above blue. Okay, so in this period here, when you look, orange is above blue in bonds, we could own bonds during this period of time. Whereas in 08-09, if you looked at orange and blue across a whole variety of assets, there wasn't any place to hide. There was no place to go, so you would hold cash. And then I want to highlight, and our clients are aware of this, that back December 7th, 2018, orange did cross below blue and we protected accounts during that time frame. So what it does is it helps us be involved in markets when we should be involved and protect when it makes sense to protect. And then what I did on this chart, just to kind of prove my point about the best and worst days in the market, what I did is in this time period, late 90s through I believe it was January 15th of 2019, I said, okay, give me the 25 best days in the market, so the days where the market was up the most. And those are marked in red. These red dots all mark where the best day happened, or the 25 best days. And what do you notice? We notice that the best days actually happen in bear markets for the most part, right? With the exception back in here in the early 2000s, there was this day here. But when we look at this, look at 2008, 2009. All of these best days actually happened while the market was selling off. And it happens because volatility is high, right? We know when orange is below blue, volatility picks up. Volatility means all of a sudden you get these huge gyrations in the market. +1, -3, +4, -7, those type of things going on back and forth. Not a nice steady uptrend like we saw in 07. Bear market characteristics are higher volatility. It's where we see the best days happen, is when orange is below blue. Typically price is below the blue line and even orange. And this is when we see the best days happen. And I hope this shows you and visualizes that if you missed the best days, right? If we miss all these best days in 08 and 09, I think we're okay, right? Because we're missing the whole move itself. And so we need to keep that in mind, that when we see a very large move in the market on a daily basis, keep in mind that that may not be the best characteristic of the market, even though the market was up a good amount on that day. So we can miss the best days and still be protecting accounts the way we should be, and that makes a lot of sense. All right, so how do we help new clients? When we go through this, we often get a question of, okay, maybe we're in a bear market right now, or orange is below blue. How do we possibly bring our portfolio over right now? What does this look like? So I kind of wanted to cover that. And it really all starts with relative strength. Okay, and what I'm going to use for that, to give you an example of what we mean by relative strength, is we're just going to go through a process of, should we own Coke stock or should we own Pepsi stock? And I know it's just me trying to be clever, because they had those old commercials where they blindfolded people and they compare how Coke tasted and Pepsi tasted. So that's what I'm trying to do here. And I always tell people both of them taste pretty good with a little bit of rum in them. But for our purposes today, we're just going to be looking at, should we own Coke stock or should we own Pepsi stock? And so here's a price chart of Coke stock from 2016 and 2017. And we can see more buying than selling, pushing prices up, and more selling and buying, pushing prices down. And this takes place over and over again. And then if we look at the price chart of Pepsi during that same time frame, it looks kind of similar. We can see it, but it's a little bit different. But there's really no information here when we look at them side by side, Coke stock, Pepsi stock, that you sit there and go, it's very obvious we should own this one thing. What we do to solve that is we actually create a math problem and solve it. So we take the price of Coke stock and divide it by the price of Pepsi stock, and that gives us a ratio, which also travels on charts, and it looks like this. Right? So we took the price of Coke stock, divided it by the price of Pepsi stock, and what we know is, for mathematical certainty, is when the ratio is falling, that means Pepsi stock's doing better than Coke stock. And when the ratio is rising, Coke stock's doing better than Pepsi stock. Now, where this gets powerful is we can combine it with our orange and blue lines, our rules. And we can just simply say, when orange is above blue, we'll own Coke stock. When orange is below blue, we'll own Pepsi stock. And then we can switch back to Coke stock. And to prove that point, by switching to Pepsi stock, so buying Pepsi stock here, and selling it here, from this point to this point, while Coke is up 4%, which is nice, Pepsi's up 10%, we like that better. Then we can switch to Coke stock here, which during this period of time is up about 1.5%, while Pepsi's down about 4.5%. So over the course of that whole sequence here, we're outperforming 10% on a relative basis, right? So we're making sure that we're owning the relative strength of the market. And so how do we apply this then to new client portfolios that come over? Well, what we do is we take the portfolio that comes over, the assets, the stocks, the bonds, the mutual funds, ETFs that are in there, and we pour it into our adaptive filter, okay? And quite simply, what we ask is orange above blue in that thing that they're holding? Okay, so let's say they own some Google stock or something like that. They own some Google stock. Is orange above blue? Yes. Well, then you get to move on. If it's not, then we ask, what are the tax ramifications if we remove this? So that's why we do taxes here, is we have a good grasp on what's the tax ramifications of getting rid of this security. So, and then this is where I like to point out that we will never hold on to something that's in a downtrend just to avoid capital gains tax, because my reminder to people is that if you're paying tax, that means you're making money. And we're in the markets to make money. Markets are not our friend. We don't do it because it's fun to do, right? But we're in markets because we need to outpace the cost of healthcare. We need to outpace the cost of living. And so markets help us do that, but not if we're holding on to things that are dropping in value just to avoid paying a capital gains tax. But it is something we do consider. We do look at what's the tax impact of selling that thing. So if a mutual fund or ETF or stock that comes over is orange above blue on its own, then we say, okay, let's do the Coke Pepsi analysis with that. And relative strength wise, is it orange above blue versus the things that are in the adaptive model or the S&P 500 itself? If yes, then we can keep it. If no, then we go through the same process. Is there a tax impact? And most of the time, about 80% of the time, there's not a tax impact for two reasons. One, the funds came over in a non-taxable account like an IRA or a Roth IRA or something like that, or it came from a 401k plan, or B, the tax ramifications are so small because that thing has already lost value, so that capital gains is not all that great. But we do consider it. But if you can't pass these tests on an absolute and relative basis, then it's removed because it's not adaptive. If it can be, it's kept until those parameters are not met, right? Till these questions can no longer be answered yes. What we're doing is getting that portfolio adaptive. And so here's an example of an individual, all right, who came over, and I'm not using their real name, I protected their identity. It's based off of Mr. Wendell was a song from late 90s, early 2000s. But anyway, the funds came over in early or mid-October, and this is a growth account, right? You know, we've got some small caps going on here for a lot of the account. We've got a technology fund. They're holding Apple and Alphabet, but then they're holding some other funds, some defensive stocks like Rite Aid, General Electric, and We Energies, and then they're holding some bonds. And so remember, we're going through that process of, for this asset here, is orange above blue? Well, on that date, yes, it was. But if we compared it to the portfolio, that the model that we're holding, doing the Coke Pepsi analysis, the answer was no. And there was a tax impact of a gain, but it was minimal. And so we sold that position and moved it into the adaptive portfolio. And from the date we sold it until Monday, what would that have been, the 14th of January, this was the return. So we avoided this loss for that client, right? Because we sold it before this loss happened, because it was not a strong thing to hold. Now, this technology fund was something that could be held until it failed test 2 on November 6th. Okay, so originally on October 17th, it did pass this, but it failed test 2 on November 6th, and so it was sold on November 6th. So from November 6th until January 14th, 2019, we were able to avoid this 4% loss in that position. Now, here's Google. Google passed the first test and the second test, and it wasn't until December 7th because we saw the main market signal fail. Remember, we talked about, for example, the S&P 500 orange below blue. So the whole market itself was orange below blue, so we sold this position. Now, from that date, December 7th through January 14th, it was up a little bit. So it's not perfection throughout the whole thing as far as avoidance, but as a whole, using this process of, does it pass on its own? Does it pass on a relative basis? Hold until it does. For this individual, from the point of sale until January 14th, 2019, we were able to save this individual about $23,000 in loss, or about minus 4.8%. So that kind of gives you an idea of how we go about this, because a lot of places, they'll take your funds, they'll sell them right away, and then they'll move them into their preferred model, and that's it. We take great care in the assets that are coming over to make sure we're handling them correctly, okay? And so that, or as best we can, right? Because it might be, they maybe shouldn't be in the portfolio because orange is below blue, or they are on a relative basis, and we take it in an incremental approach. Or maybe the market as a whole is orange below blue, and we're going to hold more cash until the market turns around. We're going to do that too. So we are in the process of risk management. We do that with new money as well. So I hope that gives you a good idea how this works for an incoming individual. Now, jumping into this most recent correction that happened in the fourth quarter of 2018, so mainly October and December were the big ones. Is this the beginning of something bad, or is it just a correction? And when we look at the past times when the S&P 500 has dropped 13% in the fourth quarter, these are the dates that happened. These are the time periods, right? So not every fourth quarter is like this, but the fourth quarters that have been like this, that are minus 13% or greater, some of these are those periods of time. So the 08 financial crisis, 1987 Black Monday, 1973 energy crisis, 41 World War II, the Great Depression, major recession in 1920, World War I, 1917, 1907 financial crisis. That doesn't give us warm and fuzzy feeling that this is how fourth quarters looked before. But that's not a guarantee that bad things are going to happen, okay? What we know is that news and predictions aren't going to help us, right? The news loves sensationalizing things. For example, here we see that they're predicting a win in the presidential election for Hillary Clinton, and we know they were wrong. We look at the media was all about if Trump wins, the market's going to crash. They were wrong. Okay, I gotta drive this point home more and more. It's very obvious that the media doesn't have our best interest in mind. The media's job is to sell advertising to you, right? You are the product. You are the thing that they need to sell to, because the more eyeballs they get, the more listeners they get, the more advertising they can sell, because other people want to sell products to you, whether it's razor blades or cars or whatever it is. Their job is to make things sensational. And so if you go around saying if this person's elected, the market's going to crash, it's going to drive a lot of clicks, a lot of views, and it's just simply not true that if Trump won, that the market was going to crash. It didn't happen. So they were wrong. Same thing, beginning of 2018. Off to its best start in 31 years, that bodes well for the rest of 2018. Everybody's saying the market's going to be higher. You're going to feel stupid if you're holding cash. Well, they were wrong. That wasn't correct. By the end of 2018, the market had a negative return. What does that say? What are we looking at for beginning of 2019? It's kind of a mixed bag. We've got some financial media saying, assume the crash position. I mean, look how scary this one is. They've got fireballs coming out of the sky and people are hiding, trying to hide from it. I mean, that's pretty scary stuff. On the other hand, we've got all sorts of experts here that are predicting, the S&P 500 to be much higher. So it's a little mixed bag. It's not like 2018 at the beginning, where both the media and experts were all about us finishing higher. We've got mixed results here. But what I can tell you is that the best way we can fight that nonsense, that the bad information that we're getting, is we just turn off the TV. I'm going to tell you a story that bothers me. I can't remember what we were watching beforehand, but somehow we ended up with the local nightly news on at like 6 o'clock in the evening on a Sunday, I believe it was. My daughter's watching it with us, and the first 3 stories are so depressing. And I got really choked up when I gave this presentation live, because my daughter turns to me and says, and the local news is Milwaukee for us, and she says to me, "I'm never going to go to Milwaukee." And I turned to her and I said, that is not true. The people and places in Milwaukee are wonderful. And right now the news is just focusing all the negative. And you need to understand that this is happening on a national scale. Okay, the depressing articles, the narrative, all the negative stories. This is in my personal opinion, a pandemic with news coverage being so negative and not providing proper information. I mean, think about it. They're causing a 12-year-old girl to say, "I'm never going to Milwaukee." Well, those events that they're reporting on may be factually true, like a certain somebody getting harmed or something like that actually happening. We also need to realize that it's not as bad as the news makes it seem. So the best thing you could do, turn off the TV, turn off the news, call your neighbor, call your friend, call your family, have a quality conversation with them. Do those types of things. Don't get caught up in the sensationalism of the media, because we've already gone through some examples of how they're wrong. What we can do is we can use the facts, right? We can use price to determine what kind of environment are we in, right? Orange above blue, things are great. That's an environment where we want to grow. Well, right now, orange is below blue, so is that an environment we need to protect in? Absolutely. And to drive that point home, this is happening more than just in the S&P 500. Here's the New York Stock Exchange. Okay, this is about a little greater than 2,000 stocks. It has local, domestic stocks in it, but also has some international companies that are raising funds in the United States for their operations, like Toyota. They will issue stock in the United States for their operations. And what we see is orange is below blue in the NYSE. Russell 2000 is the 2,000 small cap companies, smaller companies in the United States that have stock. Orange is below blue. The NASDAQ 100, these are our big technology companies. Orange is below blue. This is a representation of the entire world stock market minus U.S. stocks. Orange is below blue. So We know that we are in an environment where orange is below blue and accounts need to be protected, but why is this happening? Well, it could be incoming corporate defaults. We kind of talked about that. GE is restructuring their debt. A utility company, PG&E out in California. I know there's some wildfires, but utility companies are supposed to be safe, and they're talking about bankruptcy. There's hedge funds that are closing, and so it causes forced selling. When we look at oil and new housing, it looks like economic contraction. We're seeing Goldman Sachs and Deutsche Bank, huge financial institutions selling off. So is there financial distress? The protests across Europe, I know that they're talking about the Yellow Vest protest in France being about a gas tax. It's not. Do your own research. That Yellow Vest protest is spreading across Europe, and it has to do with the UN Immigration Pact. Big tech regulations, are those coming? Facebook is getting in trouble because they were actually selling data, not just giving it away. Google was manipulating YouTube views. Twitter is shadow banning people. Is there corporate fraud? When 2000 happened, you guys might remember Enron. Well, they were busted, meaning Warren Buffett always used to say, when the tide goes out, we find out who's been swimming naked. The early 2000s was a classic case. Once the market started falling, we started finding out who was cooking the books. So if we do, and it's a big if, I'm not saying we're correcting further from here and we're in a bear market, but if we do, we're going to find out who the corporate frauds are. Then, of course, there's always something that we can't possibly know everything. And so is there something unknown lurking in the background that we're not aware of that's taking place? But what I do know is we won't know until the move is over what it was all about, right? I always tell people wet streets don't cause rain. It's the other way around. Rain causes wet streets. Same thing. Market movements happen first, then the news reports it. It's not the news that drives price. It's price that drives news. Always remember that. And so when we see banks selling off, again, U.S. banks, European banks, that doesn't give you a warm and fuzzy feeling. We want to see banks doing well. We want to see these institutions turn around for there to be a continuation of the bull market. Oil, big economic indicator, right? It may not be the best thing in the world if oil is selling off 30%. We want to see, I'm not saying we want to see oil at $100 a barrel, but when you're paying gas, when we're at the gas pump in Wisconsin, we're paying around $2 a gallon. Remember, it's all supply and demand, and if we're not seeing enough demand, that means there's not enough economic activity to drive that. So while a $2 per gallon price might make us feel good personally, from a big picture perspective, you have to wonder about it. Home builders, right, down 25% since the beginning of 2018. That doesn't give you warm and fuzzy. We want people to be buying houses. We already talked about these technology companies that have dropped since the beginning of October by big amounts. So is there something going on that in the technology space? But here's the deal: we do not need to predict. We'll leave that to people who like to entertain, right? We don't need to predict. We need to have a plan, and that's what the Adaptiv System does. Some of you might remember this chart from my presentation back in October. Okay, this is back in here. This had just happened prior to my presentation. This was the day of my presentation was this day here, but this had already taken place, and we had pointed out the fact that this was not a great situation, because when we looked underneath the hood of the market, right, we always talk about the stock market. It's not just a stock market, it's a market of stocks. During this rise in the middle of 2018, we were seeing, if you can envision looking at a marathon race from an aerial view, we were seeing less and less runners participate in that race on the rise up. So it was a few stocks that were holding the market up as a whole here. And when this correction started happening, we started talking to our clients and those who had came to our lunch and learn that something was different here and we need to be careful with it. By December 20th, I had sent this video. We'd already protected accounts on December 7th, right here, orange crosses below blue. And within a very short period of time, and actually the market dropped further than this, about a 10% move down in a very short period of time. Risk happens fast, and that's why we use this system to protect. Because when orange is above blue, great. Potential upside reward is greater than potential downside risk, and we want to be involved with that. But when orange is below blue, we don't need to be driving in a blizzard. Potential downside risk is greater than potential upside reward, so we're in a protect environment. But what is our game plan? What is our plan, right? Because we're not going to predict what's going to happen. What I want to highlight here, I'm going to use the S&P 500 again, but what I want to stress is that There are so many asset classes, bonds, commodities, currencies even, major markets, major sectors that have a similar look to this situation right now. And that look is we are back into an area. Price has had a really nice, the market's had a really nice start to the year. We're rising up into this area where the orange line is. And what I want to highlight there is, notice when we're in a nice uptrend, when price gets near orange in these areas here, it starts to rise up, right? When it hits orange, it starts to move back up because institutions are stepping in and buying, okay? I want to know, is our institutions going to show up and sell like they did here near the orange line? We don't know yet. We're going to find out, or I should point out, we do know, since I gave this presentation, I can tell you that price has moved above here, okay, and that's step one. That's a really good step for the market itself, because typically what happens is, see how buyers showed up here in the past, and we know they did because price moved up, right? More demand than supply pushes prices up. Same thing here. What typically happens is when we move back up in these areas, that's where sellers show up, right? Because if you think about it, if you think about someone who bought stocks up in this area, this whole box right here, this is where the dead bodies are buried, right? So if you bought stocks up in here, you are now negative up until this point, and if you get back to even back in here, what are you doing? Well, you're going to sell because you just got your money back. We have to think psychologically about this. And so what we typically see is that sellers show up again. But what we have seen is buyers have shown up here and driven price over this, what's called a resistance area, and above orange. So that is step one. That is a good step towards seeing if we can get orange back above blue and a positive bull market happening again. So one of the bellwether stocks we look at is JP Morgan, because it's one of the most important financial institutions in the world. And so we look at them for clues. And so here is a picture of JP Morgan, or I should say a chart. Notice how it looks very similar to the S&P 500 from the standpoint of it's back into this area where buyers had shown up before, but it failed in December. We're back here and we're up against this orange line. Very similar to the market as a whole. It's a canary, if you will, in the coal mine. If JP Morgan starts to sell off here, we have problems. Okay, I'll put it that simply. If JP Morgan starts to sell off, we have problems. But I can tell you that between when I gave the presentation and when I'm recording this, that price did move above this level, and that's an important first step. Okay, that's a good thing for the bull market. But there's many, many charts that look like this. Okay, so we're keeping our eye on that. We're also looking at panic assets. Okay, those panic assets are assets where big asset managers who are imagining billions and trillions move into. Okay, so when we saw the market selling off, right, when we saw the S&P falling in price, we saw these things going up in price. Okay, so yen, gold, and treasuries, people were selling stocks and getting into these things into protective mode. Then what's interesting is as the market rose back up into these levels, these things have stayed the same. They have not sold off. They've just stayed level, which is interesting because what you'd want to see is you'd want to see these things sell off while the market rises. Now, on the Friday before I recorded this, we started seeing these sell off. It just started happening. So that is a positive development. We also look at market breadth. Remember that marathon analogy I gave where you can look at what is going on in the market of stocks, how many stocks are participating to the upside. We can look at that, and what we are seeing is that more and more stocks are participating. It almost has the look of a new marathon starting, the gun triggering and everything starting over again. So we're going to keep an eye on that. That's a positive development. So are we in a bear market? We don't know yet. Orange is below blue, so we're in a protective environment. But the reason why I even used this picture, right, was because we can be adaptive, right? We don't have to just say it's a bear market. Now, orange is below blue. We want to take an abundance of caution. It's still more risk than reward out there right now. But we are seeing signs of the bull market returning, and we're going to participate in that trend when it does. Okay, we're ready for either scenario. We're ready for a bear market, and we're ready for a bull market. And so we want to be cognizant of those things and be adaptive and not protect. And I encourage you, if you have questions, to email us at myteam@clientfirsttaxandwealth.com, and we'll do our best to get back to you. And what I want to finish with is we always want to be identifying risk versus reward, investing with the direction of the trend, managing risk using weight of evidence, staying disciplined to the system, which spells AIMS, which is the Adaptiv Investment Management System. We also want to be highlighting here that we use the Adaptiv System for other organizations like alma maters and churches and communities. Something that you're passionate about, let us know, and we will be happy to meet with you and meet with any organizations, because Adaptiv System works good for that. You can find more out at clientfirsttaxandwealth.com, endowments and foundations. Next month is the latest trends and research on consumer privacy and data security. That is February 20th. So join us for that. It's good food, good information. Paul is going to be presenting that information. He's going to cover 9 real-life case studies. They all happen in Wisconsin. 2 important new regulations, both in Europe and the United States. And then 3 predictions. These aren't predictions like market predictions, but these things that you can be looking at to combat fraud from criminals. As a reminder, it is tax season. For those ages 50 and above, we do offer this awesome tax special for $79. Call us, okay, 262-335-1700 to get your taxes scheduled. You can also email us at myteam@clientfirsttaxandwealth.com. And the reason why we do taxes is because it fits into your true holistic plan, right? Those who have a bucket plan have a lot less time worrying about money than no plan. Those who have the Adaptiv System are being protected from uncertain markets. Those who use us for taxes, it helps keep them from getting stressed out and get organized. That's why we use the true holistic process. And finally, we're here to help. Okay, we love our clients. If you'd like to meet with us and go over these things, whether it's the Adaptiv System or true holistic planning, do call us, 262-335-1700, or myteam@clientfirsttaxandwealth.com. That concludes our presentation for today. Thanks for joining us. Feel free to share this video with others, and we'll see you next time.